Welcome to The Explainer. Today we're unpacking some truly fascinating research that proves building lasting wealth actually has way less to do with being a math genius and almost everything to do with how you manage your own behavior. We're going to dive into some evidence-based frameworks that literally strip the emotion right out of your money so you can just focus on building the life you actually want. Real quick, here's our agenda for today. 1. Our brains against our wealth. 2. Human capital in changing times. 3. Setting goals with PERMA. 4. The 5% housing rule. 5. The math of doing nothing. And finally, number 6, the just keep buying strategy. All right, section 1, our brains against our wealth, why human evolution works against successful investing. So our brains are fundamentally wired for immediate survival, right? Not exactly for this abstract idea of compounding numbers in a brokerage account over 40 years. The legendary investor Charlie Munger hit the nail on the head when he said it's not greed that drives the world, but envy. Think about it. It's not just that we want more, it's that we want more than our neighbor. And this huge psychological blind spot, it leads us to chase trends, panic sell during market dips, and basically turn what should be a naturally winning long-term game into a loser's game. And this perfectly sets up a very real behavioral hurdle called present focus bias. Basically, this is our hardwired cognitive tendency to prioritize immediate rewards over long-term benefits. When the stock market takes a nosedive, that immediate emotional pain literally feels like a physical threat to us. We just want to do something, anything, to stop the bleeding. So we hit sell. We're prioritizing that instant relief of taking action over the massive long-term benefit of just waiting it out. So, the practical takeaway here? Honestly, it's surprisingly simple. Stop checking your portfolio. Academic research literally shows a direct correlation here. The more frequently you check your portfolio, the worse you actually do. So, do yourself a huge favor, delete that app with the flashing red arrows right off your home screen. Automate your investments, step away, and let time do the heavy lifting for you. Okay, moving on to section 2, human capital in changing times. Earning potential in an era of rapid technological shifts. Now, before you can invest any financial capital, you've obviously got to generate it first. So you really need to understand your human capital. This is basically the economic value of your experience, your skills, your knowledge, and your time. But here's the really vital concept. Your human capital naturally diminishes as you age. I mean, you only have so many working years, right? So the entire goal of personal finance is to steadily convert that shrinking human capital into growing financial capital, so it can sustain you when you're finally done working. What's super interesting right now is how the market disproportionately rewards what we call a rare complementary skill stack. Common single-track abilities, they're getting easier and easier to replace, which leads to stagnant income. But when you start combining skills, say traditional mechanical engineering paired with the modern ability to create engaging video content, or maybe deep biotechnology mixed with top-tier copywriting, you create this incredibly unique, high-leverage profile that is so hard to replace. The crucial takeaway for this section is that your absolute best defense against our rapidly evolving AI-driven economy is aggressively developing specialized skills. Don't just sit back. Actively build that complementary skill stack and find an industry that places a massive premium on it. Because maximizing your income is, without a doubt, the most effective way to guarantee you actually have surplus capital to save and invest in the first place. Up next, section 3, setting goals with PERMA. Defining what a good life actually costs. A lot of times, we set our financial goals based on what society tells us we should want, like a massive house or a fancy luxury car. But the PERMA framework forces you to align your money with the 5 actual pillars of human flourishing. Those are positive emotion, engagement, relationships, meaning, and accomplishment. If a financial goal doesn't actively support at least one of these pillars, honestly, it's probably just a distraction. Using this model prevents you from wasting decades of compounding wealth on stuff that won't actually bring you any real satisfaction. As data scientist Nick Maggiulli so brilliantly puts it, fund the life you need before you risk it for the life you want. The ultimate purpose of your money is to secure those baseline requirements for a genuinely good life before you take any unnecessary risks. Define what you actually need using that PERMA model, lock down that foundation, and only then should you start reaching for the luxuries. All right, section 4, the 5% housing rule, unpacking the biggest financial decision of your life. We have all heard it from that one well-meaning relative, right? Renting is just throwing money away. But Is it really? Or is that just a culturally ingrained myth that totally ignores the actual math and the huge opportunity costs of homeownership? Let's take an objective look at the numbers. Here's the deal. Renters just pay rent. That is literally the absolute maximum they are going to pay for housing each month. But for homeowners, the mortgage is just the minimum they'll pay. Owners face these massive unrecoverable costs. We're talking mortgage interest going straight to the bank, property taxes hovering around 1%, relentless maintenance costs, which research shows average around 2% of the property's value every single year, and, critically, the massive opportunity cost of tying up a huge down payment in drywall instead of the stock market. So to approach this like an engineer, we use the 5% rule. Here's how it works. Take the total price of the home you're looking at and multiply it by 5%. That covers your taxes, maintenance, and the cost of capital. Then divide that number by 12. That gives you your break-even monthly number. If the monthly cost of renting a similar property is cheaper than that calculated break-even point, mathematically, you should choose to rent and then aggressively invest the difference in the stock market. Your practical takeaway here? Stop treating a primary residence as this guaranteed magical investment. It's just not. Use the 5% rule to objectively measure your true unrecoverable costs. And hey, remember that renting offers incredible geographic mobility. It allows you to pack up and move for better career opportunities without getting absolutely crushed by real estate transaction fees. Section 5. The Mass of Doing Nothing. Why Inactive Investors Win Over the Long Term. Basically, there are two distinct paths when it comes to investing. On one side, you have active management. That's all the stock picking, trying to time the market, and frequent trading. The data completely proves this is a high-cost loser's game. On the other side, you have the evidence-based winner's game, which is passive indexing. This just means buying a broad market index fund that holds basically all the stocks, keeping your costs incredibly low, and then literally just sitting back and letting the magic of compounding returns do its thing. Just to really anchor the power of this compounding with some hard numbers, think about this. An investment of $10,000 in a broad index fund, returning roughly 7% over 40 years, turns into $150,000. That is wild, right? And it reveals a pretty stark truth about opportunity cost. When you blow 10 grand today on a depreciating asset like a car or those daily premium coffees, you are functionally stealing $150,000 from your future retired self. You've really got to ask yourself if whatever you're buying today is actually worth that massive future cost. And that brings us to Section 6, the Just Keep Buying strategy. Automate your behavior to guarantee wealth. If you want to practically guarantee long-term wealth, the strategy is this: continuously buy low-cost broad market index funds. Start right now, because time in the market beats timing the market every single time. Oh, and here's a fantastic behavioral trick for you. Use the 2x rule. If you're going to splurge $300 on, say, some luxury headphones, force yourself to invest an equal $300 into your index funds at the exact same time. It totally removes the purchase guilt and makes sure you're always building assets. But above all else, completely ignore the urge to time market dips. Seriously, just keep buying. So your final practical takeaway comes from a famous, albeit slightly morbid, financial adage. The best investors act almost as if they're dead. Yeah, dead. They don't react to the chaotic financial media, they don't panic sell during market corrections, and they definitely don't chase the latest hyped-up stock. They just trust the basic arithmetic of passive indexing and leave their portfolios entirely alone. Which leaves me with this final question for you. Take a step back and look at your current financial setup. Does your portfolio actually reflect the deep, long-term life goals you mapped out today, or is it just reflecting your short-term emotional impulses? Thanks so much for joining me on The Explainer.